Hello, Shailendra Marathi here. Welcome to this session on credit derivatives. This is second part of credit derivative session, which is a module in the credit risk management. We'll cover in this two key products in the credit risk management space, ABS and NBS, asset-backed securities and mortgage-backed securities, and also CDS and TRS, right, which is credit default swaps and total return swaps. These products are not as much popular in India currently as they are in US, for example. But it's good to know these products. They exist in the Indian market, albeit their popularity is less. Just to sort of refresh, credit derivative products are fundamentally designed to manage the risk in the credit products. So derivative products are by nature the hedging products, which are designed to manage risk. It is another matter that some of the players use it for speculation and then end up taking a lot of risk. But the key purpose of designing any derivative product is to manage the risk in the underlying security or commodity, whatever it is. ABS or MBS. Now, asset-backed securities means securities that are backed by any kind of asset. That asset could be a house, any other real estate property, a land, could be a motor car, for example, uh, or anything like that, right? So it's an asset. Uh, Mortgage-backed securities specifically refer to the securities that are created and backed by mortgages. And mortgage basically means lending against the real estate, right? Mortgaging of the property. Now, that is why, by nature, MBS is a security which is a part of ABS. So ABS would include a lot of securities, of which one is MBS. The reason MBS is mentioned specifically is because mortgages, the housing loans, are a big part in any economy. A house typically costs a lot more than, let's say, car, right? And that's why the market for MBS is very huge. And that's the only reason it is mentioned separately. And the securities issued against the mortgages are fairly high in terms of their overall volume and trading. Now, what exactly is this securitization process? These ABS or MBS are securities which are derivative securities. That is, they are created on back of some other securities. I'll talk throughout now on MBS only, but you should keep in mind it could be anything other than mortgages also, like a vehicle loan or credit card portfolio. Now, let's say there is a portfolio of mortgages. The bank has lent uh, to many, let's say, customers, maybe 10,000, 20,000 customers. In Indian context, this portfolio could be very, very big, right? So, because typically a housing loan could be 25 lakhs, 50 lakhs, 75 lakhs, 1 crore, 2 crore, right? So, 10,000 mortgages could mean a few thousand crore rupees as well. So the bank has lent, to various people against their mortgages of property. Now, there are times when the banks wants to reduce the risk to mortgages. For example, they feel that there is a very high exposure to mortgages. They want to reduce that risk. That could be the reason they are, wanting to sell those securities to somebody else, or they may require liquidity, right? So bank needs liquidity. So they might sell some of their existing assets, and loan is an asset in the bank's book, right? So they might sell some of these mortgages and try to raise the funds for more expansion or for any other obligation that they have to meet. For example, they have to pay dividends or they have to repay any kind of loans or anything like that. Now, these securities or these loans are relatively small value. Now, maybe even 20 lakh, 50 lakh. Now, you can't sell this individual loan to another bank, right? So, that is a very tedious process. All these agreements typically, if you are a borrower, they mention that lender can sell this loan to somebody else. That is, he can transfer the ownership because that's an asset for the lender. They are lending to you, so it's an asset in their book. They can sell it to someone else, right? And then you have obligation to pay to that another person, which is, I think, a fair obligation. As long as our terms and conditions are not changed adversely, most of us are okay with that. So what they do is, since individual loan amounts are relatively small in the banking world, right? 50 lakhs is a big amount for individual, but they'll package these lot of mortgages together. So a lot of agreements with their customers, maybe 500 agreements, 1,000, 2,000, 4,000 agreements, right? They'll package together, and then the value of that asset may be, as I said, couple of hundred crores. and then they will package it together and they will sell all that package to someone else, right? To create liquidity or to reduce exposure in that particular asset class and reduce the risk. Now, this process is basically called securitization process. So you select borrowers who have borrowed from you. You create a schedule of those borrowers, put together, you create a master agreement and say, these are the agreements which are part of this particular securitization process. So you have to identify an agreement number, date on which it was signed, who is the borrower, what is the property. Those details you put together and create a sort of master agreement which says all these loans are being packaged together and they are being sold off, right? Now, who are the people interested in buying this kind of mortgages? See, bank's business or a housing company's business is to give loans like this and then follow up, get the everything, the EMIs collected, etc. That's their business. Which means they have got sourcing channels. Agents will go to people who are looking for home loans, get their documents, do all the processing, do the underwriting or risk management, right? So do credit evaluation and then give the loan, disburse the loan, get all the property documents, maintain that, right? And then collect the payment again. So all these process they are able to do. At times, this process is outsourced to specialized players who are called mortgage services providers, right? So these people are mortgage operations sort of companies, which are kind of BPO or KPO operations, and they do all this loan servicing on behalf of the banks. Now, the buyer may not be interested in doing all this. For example, you are a hedge fund who is looking at taking exposure to the mortgage market. But hedge funds don't have all this machinery to process mortgages, maintain documents, right? Later, you have to give the documents, or you have to sort of take out the charge from on the property, right? So all these things they are not interested in doing. But they may want to take a exposure on this market. A pension fund may want to take exposure on this market. A life insurance company may want to, insurance company might want to invest in mortgage market because they may find that the returns are attractive, and they may like to diversify their portfolio and might take some exposure on the property market as well. So they are the buyers typically in this case. Now, when these securities are put together by the bank, then let's say the valuation comes to 500 crore rupees, right? So that's a 500 crore rupees. Various mortgage agreements, borrowers agreements being put together, clubbed into one agreement, and now the bank can set it off to other parties. What banks do is they incorporate a company which is typically known as special purpose vehicle in the finance world, right? So it is a company incorporated with a specific purpose, right? The purpose is buying these securities from the bank, right? And in turn creating securities of a higher denomination, rather than 20, 25, 30 lakh rupees loans, create let's say 1 crore or 5 crore or 10 crore securities on top of that, and then sell it to the other parties who are interested in taking exposure in the mortgage market. So for example, this 500 crore portfolio, the banks will set up a SPV and sell that portfolio to the SPV. The SPV, let's say, creates 50 securities of 10 crore each, right? On these 500 crores of assets, right? So now what they have done is under one agreement, all these 500 crores of mortgages are there. So they will issue 10 crores securities on top of this. Now the securities of a higher denomination in which these pension funds, hedge funds, etc., who might be interested. They are not interested in 20 lakhs, 50 lakhs mortgages because that's not their business. And now they are also not interested in managing these mortgages. So typically, the bank, if it is doing the mortgage processing servicing by itself, they will appoint a third party mortgage service provider and hand out the agreements and everything to them, saying now you process it, and that mortgage service provider will service this SPV now onwards, right? So they will take care of all these operations aspect of collecting EMIs, otherwise the EMI bounces, follow up, right, levying penalties, returning documents, right, all that thing they will take care of. So now this SPV has got this 10 crore, each security of 10 crores, which are 50 securities, and they will look for the buyers for that. Typically, the buyers are also simultaneously being looked at, and that they will send it to pension funds, endowments, big companies which are looking, any kind of financial institution looking to take a exposure to mortgage industry, and then they will sell those securities of 10 crores to various players. So what has happened in this process is small mortgage agreements have been bundled together, have been sold off to SPV, and SPV has created huge denomination, large denomination securities on top of that, and they have sold it off. So these securities are now a derivative product because the underlying of those is these small mortgage agreements, right? So that is what is exactly mortgage-backed securities are. They're backed by the mortgages, right? Now, in this mechanism, once the securities are sold, typically the SPV will take that money and they will give the money that they have to give to the bank, which has basically sold. Now they are basically originators, right? They are called as originators in this particular diagram or depiction. There could be various originators which have originated these mortgages and taken them on their books, or there could be single originator who is packaging their securities and selling, right? So originators can come together and create a pool also, right? So that's called basically asset pooling, right? Pooling those assets together under one master agreement. Then selling it to SPV. Then mortgage service provider will sort of service that. It will be created into an asset-backed security or a mortgage-backed security and sold out to various investors, right? In this process also, in case the investors are worried about the quality of the assets, the credit rating or the default risk or the repayment capability, then third parties might give the credit guarantee also for this security, right? In case the mortgages are not honored, right? So the default is there in terms of payment, then we will pay, right? So there are players in the market who give credit guarantees, or the originators might guarantee for a certain period of time because they want to make sure that these investors have the confidence in those mortgages. So they might say, for next 3 years, on an annual basis, we will renew. Will guarantee that these mortgages get repaid, right? If not, we'll pay the money. Now, what they have done in this process is they have got the cash. Investors have invested in the mortgage-backed securities. Mortgage service providers, it is their business to service their mortgages, right? And credit guarantors could be third party who are making money in the process by guaranteeing the repayment, right? So that's what is exactly the securitization process. And as I said, it could be mortgages or some other asset. For example, credit card portfolio, it could be, for example, the vehicle loan portfolio or anything like that. Now, in this process, there could be assets or the mortgage agreements which are of different quality, right? So there may be people with low credit scores or who have sort of defaulted in repayment once, right? And there could be those with slightly higher credit score and who have never defaulted. And then there could be A-class securities, right? So mortgages which are of good quality. Now they may be packaged together because otherwise, if all of them are under one sort of you can't identify good from the bad ones, or less, I'll say high quality from the relatively low quality one. Then the investors buying may be hesitating. I don't know what is the quality of the underlying agreement. So there are rating agencies, etc., which are involved in the process, and they certify these MBS or ABS as maybe AAA or whatever the rating that they want to assign to those mortgages. And typically, then what you do is based on those mortgages, you put them into A class, the next ones into B class, and then into C class. Obviously, those who are buying C class securities, those 10 crore securities which have underlying C class mortgages, right, not very high quality, likelihood of default or non-repayment is more. They are not going to pay 10 crore for their security. They may pay, let's say, 7 crore for that or 8 crore for that, right? Whereas senior A class securities might fetch more price than 10 crores also, right? So that's how the entire portfolio is sold off to the investors. Now, the A class securities can be very good quality mortgages, or maybe for which any credit guarantee has been given, or credit enhancement as it is called has been done, in which case it becomes maybe from B to A class, because if third party is guaranteeing, then then I'm not worried, right? It becomes a A class security for me. Typically, when the repayments are coming back on the mortgages from the borrowers, then the cash flow goes first to A class security, then to B class security, then to C class security. And the risk of default is first borne by the C class securities and then B class. Right? That kind of arrangement can also be done. Not necessarily that the cash flow is like this in every case, but it can also be a part of the agreement. This is what is called as cash flow waterfall. Credit guarantees I have mentioned is pass-throughs. The cash flows can, as they come, they can be passed on after deducting the administration charges, etc. Different assets can be combined, right? Or you can separate out into A, B, C class. And lower grade assets, you can do risk underwriting, or you can ask somebody else to sort of assess that maybe of a lower quality, or give credit guarantees, or some such things you can do to make it attractive for the investors. Or maybe that 10 crore security created out of low grade assets, you may sell it at discount, right? So because the likelihood of default is there, but still you want to get money. It's a low quality asset, you may not get exactly 10 crores out of that. So this is fundamentally what ABS and MBS are. So pulling together small value borrowings, which are your customers, It could be very different banks, etc., coming together and pulling that into a asset pool. Then going back and sort of creating the setting up a special purpose vehicle to whom these mortgages are sold. Then getting the credit enhancement for to be done for that, or appointing a mortgage service provider to take care of all the mortgage servicing, and then creating higher denomination securities, because the investors may not be interested in individual mortgages. No, otherwise, because that may not be their business, right? Managing mortgages is not the business of the hedge fund, etc. And then selling out those securities. Right? So in this process, the originators are getting liquidity, they are getting the money, right? Before, because otherwise for mortgages they have to wait for 5 to 10 years, and then also they are reducing their risk to a particular portfolio, their exposure. And these investors in this process, they are getting exposure to mortgage market, which otherwise they cannot get. They are not in the business of mortgages. So these are ABS or NBS. As I said, relatively less market in India, but this is very popular in the US. And these securities were one of the key securities involved in the global financial crisis of 2008. Right. So because many of these mortgages were of really bad quality, given to people. These are called ninja loans, right? No income, no jobs, no assets, kind of people they were given to. Another derivative product is what is called CDS, right? So CDS is basically credit default swap, and there is a sort of another version of CDS which is called TRS, which is total return swap. Right? So what exactly is credit default swap? Default means credit risk has occurred and the person is not able to repay. The person or the organization is not able to repay. Let's say a person is not able to pay back his housing loan, or a company is not able to pay back pay back the money that they are supposed to pay on a bond, right? So then in that case, how do you insure yourself against this kind of an event happening, right? So typically credit default swap are the ones where somebody has guarantees in case that company doesn't pay. This is a company which is coming out with bonds issue, and they are issuing 600 crore bonds. Now there may be people who are interested in taking exposure on those bonds, but they may be looking for a sort of somebody who's a guarantor, right? In which case this somebody who can assess the risk well, and that they are in that business, right? Guaranteeing is a business, just like bank gives bank guarantee and they get the commission. These people get premium for writing credit default swap. So they may say okay, we will be writing a credit default swap on this for 1 year. And then every 6 months we have to pay. So you pay right now, and after 6 months you pay another. Let's say right now 0.5%, and after 6 months 0.5%. So you pay us 1%. Let's say that is a 600 crore of portfolio they are giving CDS against. They are writing credit default swaps. Then they will get about 6 crores, right? 3 crores right now and 3 crores later. It could be any amount, depending on the quality of the bond, etc. So that's exactly what CDS is. So it's a CDS is a bilateral financial contract between two parties, in which one counterparty called a protection buyer, right? The one who wants to buy protection, just like I'm, let's say, buying the insurance for my car, right? There's a periodic fee. I mentioned 6 months in this case, typically expressed in basis points on the notional amount. So basis points is basically 1 basis point is 1/100th of a percentage, right? In this credit products, etc., basis point in the fixed income products, the basis point is a terminology very frequently used. So the example I gave is 50 basis points, right? 0.5% is what you have to pay every 6 months in return for a contingent payment by the protection seller. So the one who is giving the CDS, is taking the obligation, who is writing the CDS, saying that I will pay you in case the company doesn't repay the bonds, right? In case the default happens. So that is called a credit event, right? They will define what kind of a event, in that eventuality I will pay you. Reference entity is possibly that company which is issuing those bonds. But it is very important that that agreement very clearly specifies all those things, right? So which are the counterparties, what is the fees, for example, then when that fees has to be paid, right? So basis points, the credit default swap premium, when it has to be paid, what exactly is the event, how we will identify that event, right? Event could be, for example, bankruptcy being declared by the issuer company, right? The one which has issued the bond, or maybe that company has failed in repaying some earlier bond, right? Or maybe a court order has been passed, for liquidating that company, something like that. So those things are mentioned there in detail. ISDA, the International Swap and Derivatives Association, is the US member body, right? So it's a self-regulatory organization set up by various banks and other big players in the US, which basically defines the process, the contracts, and other things for the credit default swaps. Right? They also define it for other OTC products, over-the-counter products. CDS is typically a over-the-counter product. It doesn't get traded on the exchanges. So they have standardized these agreements, these letters that need to be exchanged, how the CDS has to be acknowledged, and so on and so forth. So all the standardization of the process ISDA has done, and the members of ISDA follow those standardized processes. Otherwise, it's very difficult. Everybody writing different kind of agreements, right? So ISDA has done good work in this regard to standardize the process as much as possible. In case of OTC products, of course, you cannot 100% standardize, but they have done the standardization to the extent it is possible. There is a trigger event that is defined, as I mentioned. What is the event in which case the default is triggered, right? In which case the person who has bought the protection from the CDS writer, right? When they can demand the money, right? So bankruptcy happening for that, company which has issued bonds, for example, they can go get into insolvency, court appoints a receivership, or some material adverse restructuring of debt happens. They restructure the debt obligation to some other company to which the investor to whom they have issued the bonds, right? So which means that company is not doing well, or failure to meet payment obligations either to this particular bank holder, maybe interest has not come in, or maybe to some other series of bonds, right? So all these are defined, and then they also put materiality clause. So materiality means, is this event significant enough? For example, sometimes in the course of business, for example, a company may sort of get into dispute with some business people with whom they have their business relationship, and they may refuse to pay the amount. Right? This can happen in businesses. And in which case that person may appoint go to the court and may win, sort of a receivership. Sometimes this kind of things can happen. So just for, let's say, 1 crore rupees. Now that company is a very big company, right? But just 1 crore rupees of order has been passed, right? So later they will go to the court and they will get that order scrapped. They will repay the amount, etc. Those things they will do. So here say, any let's say any such event which has impact of less than, let's say, 10 crores, right? That will not be counted as a material event, and that will not trigger the repayment obligation on behalf of the person who is selling the protection, right? So that is taken care of to manage this kind of events which might happen in business, and that should not trigger the entire sort of obligation on the part of the protection seller. If it's a bigger amount, if it's a material amount, in which case that trigger will be sort of kicking in. Some other operational modalities are also mentioned as a part of the CDS. The contingent payment, how the cash settlement will be done, when the cash will be paid. I said 600 crores of bonds being issued. Let's say somebody has taken about 100 crore bonds out of that, subscribed to 100 crore bonds, and they have taken the protection. Now, let's say the bankruptcy happened, will immediately the mortgage, the CDS writer will be able to required to pay immediately 100 crores, or they will pay 20 crores now, 20 crores after 6 months, and then the rest after 1 year, for example. Because typically in a bankruptcy and these events also, the company also might pay some amounts, right? Because they will have assets, correct? So this kind of mechanism, how the payment has to be done, etc. All those things are very clearly defined in the CDS. And also, they may say that, okay, from that event you have to wait for 1 month, because many times the company may be bought by someone else who might honor the agreements and so on and so forth, right? So those operational models are a part of the CDS contract. And then there is a structuring element, required, maturity of the CDS credit default swap. Is it 1 year? Typically, these are 1 year, 1 year obligations which are renewed from time to time. Just like we insure our car for a year and then next year again we go back for life insurance. That's how typically these might be structured. Sometimes the CDS, the protection may be offered for, let's say, 2 years, 5 years, or something like that. So these are basically OTC products. So it depends really on the counterparties, what they are comfortable with. So basically, CDS, credit default swaps, is a protection or a guarantee given by one party, saying that if the another party, right, there is a third party, fails to pay you, right, there is a credit default, in which case we will compensate, right, and for that you have to pay us X amount. Obviously, nobody is going to do it without any payment, right, because it's just like insurance, right? In insurance, you have to pay the premium. Total return swap is also sort of a derivative of a CDS, in which case there are two things. One is, in the CDS, the principal amount is covered mainly, right? So in case of default only, you get the payment. In case of TRS, you cover two things. TRS is a combination of interest rate swap and credit default swap. In interest rate swap, what you're doing is, let's say you have to pay a fixed rate of interest on a bond, right? And you want to convert it to variable. So you may enter into a contract with the counterparty that you pay our variable interest rate, we will pay you this fixed rate, which is we have to pay on the bond. Why would somebody be willing to do that? Maybe it is a bank, etc., which is in this business, so they will charge you for that. Or maybe it is another party, counterparty, which has an opposite point of view. They think that the way the interest rates are moving, I better pay this fixed rate, right? Because variable rate may be lesser, right? So you have different sort of point of view on the market, and that's why they are willing to write this kind of a swap. So the interest payment obligations, typically variable rate example is given here, is LIBOR, London Interbank Offer Rate, plus some Y basis points per annum, whatever that amount is, right? So 50 basis points, etc., on top of that. So that is how variable interest rates are defined. And then in the TRS contract, you have both interest rates covered, and then so interest rate swap keeps happening, and then you also have the credit default swap, right? Which if the party doesn't pay, then you will pay for that. Right? So again, here, for example, again you have the ISDA being involved in that. They define the contracts and terms and conditions, triggers, etc., are very clearly defined as a part of that. As I said, the difference is in the CDS you are only covering the default, right? In case the company fails to pay, bankruptcy, etc., those events. As in this case, that is covered, and in addition, you are covering the interest rate swap is also happening in that process. So that's what it is. So these are some of the very popular credit derivatives in the market. In the first part, we discussed credit options and credit futures, and in this we discussed basically ABS, ABS, and we discussed the CDS and TRS. So that covers our portion on the sort of credit derivative products, right? So thank you very much for patient listening, and all the best.